Hey everybody, welcome back to my channel, Deb's Corner. It's me, Deb here. So in this video, I wanted to talk about investing. Just the basics of investing. So just a disclaimer before I go on with this video. I am not a financial advisor, nor a fiduciary. I'm giving advice based on my experiences with investing, and I'm going forward with that. So I guess experiences teaches us lessons, but with this advice that I'm giving you, you should also go to a financial advisor. You should also go and get a second and third and fourth and fifth opinion. Never take one opinion as the truth. There are a lot of investing gurus out there, mentors, a lot of all that stuff. But I say you can always teach yourself about investing, topics surrounding all that stuff by just researching, by just going on Google. Google is your best friend. So going on Google, researching, and then listening to mentors, listening to people who can actually offer advice based on investing. You can actually teach yourself how to invest. Not a big deal. So yeah, let's get started. I have my book of notes here. I have my calculator because I wanted to give some examples. But to just get started, before you start on your investment journey, I say pay off your high interest debt first. Reason why I say that, because once you pay that off, it clears the way, right, for you to start investing. If you have high interest debt, what that does, it eats away at the money that you are supposed to use to then invest, right? It's like you have a high yielding, savings account. You earn interest on the money that you have in there, right? Based on how much you have in there, that's how much you earn interest on, right? So in that way, you can equate that to credit cards. You have an interest rate, maybe 16% interest rate, and then you have a balance of maybe 2,000, right? Let's do this as we go. So you have a balance of $2,000, right? So the credit card company is actually making money from your interest payment. The interest that's accrued from the balance that you have in your account. So you have $2,000. Let's do it together. So you have $2,000, and it's charged at a 16% interest rate, right? So that means on that $2,000, right, your bank is making $320 a year. So your annual percent yield, APY, APR, annual percent rate, is basically the money that the bank makes, or the credit card or creditors makes from your balance in that account yearly. So you have $2,000. $320 is going out yearly based on that balance that you owe. So let's divide it by 12. So monthly, that's just $26. $26 that you're actually paying in addition to how much you owe. Doesn't seem like a lot, right? But in the long run, if you keep on carrying the debt year after year after year after year, you are actually losing a large chunk of money. So that $26 that you're losing monthly, you can actually take that money and put it into an investment account, and that can yield more. So the next thing I'll say focus on is finding a brokerage firm that works for you. There are a lot of brokerage firms. You just have to find out which one works for you. There's some that actually offer you like research on companies that give you detailed like numbers and data, and then there's some that just simple like Robinhood. So you just have to find a brokerage firm that works for you and go with that. I'm not going to personally recommend anyone because we have to do our research. Investing requires research. You can't just go by what so and so says about this and what so and so says about that. You get the initial information, but then you have to take that information and then go do your research. So find a brokerage firm. So after that, I would suggest investing money monthly, on a monthly basis. I say that only because it's kind of like putting money into your savings account. It's recommended put money into your savings account to grow your savings. Is that same concept that you go about with your investment account or your brokerage firm. Brokerage firm holds your investment funds and all that stuff. It's like a bank, but for investing. So you basically I advise investing monthly. So say for instance, you can only afford $200 a month, right? Or 250 a month, whatever. Say for instance, you can only offer 250 a month. What you should do is take that money. You can do it monthly, you can do it weekly, you can do it monthly, you can do it weekly, you can do it bi-weekly, whatever that is. So what that allows you to do, once you put money in, what that allows you to do is consistently purchase shares, right? I'm going to get into this video a little later about what shares are, what a stock market is, the basic, what are all those definitions, and then you can go from there. But yeah, so once you're putting money monthly, you can then take that money and invest in some kind of company monthly, right? So that way you're pouring it into the market monthly, no matter what's going on in the market. Stocks could be trading higher one day and then trading lower on another day. Doesn't matter, as long as you're continuously investing in the market. That's how you grow your wealth. The last thing I would suggest is just finding companies to invest in, right? It's just finding companies that you can invest in. So how you go about that is just looking at what you use on an everyday basis, looking at what's in your household, kind of like what you wear on a daily basis, the brands that you wear on a daily basis. So if you're looking at your shoes and you wear Nikes, and you look at your closet, in your closet and you have Nikes, hey, I'm already a consumer of Nike products. Why don't I own some parts of Nike as well? And that's what investing offers you. It gives you that right to own a company without actually owning that company. So that's a way to go about finding what companies to invest in. And once you do that, it's just the beginning steps. Then you can then go, hey, looking at the news. So CNBC is a great resource to find out what's going on with companies, what's happening in the market, blah, blah, blah. It gives you basic information. I also go to Google News. You can find out what's going on in the company. So just constantly watching the news, looking at what's going on in the news, in the markets and all that stuff. And then you can make your judgments from that. So once you figure out what companies to invest in, this is where you need to go into a deep research. And this comes with more experience trading and investing. You then say, okay, I go into this company and I find out, okay, are they in debt? Do they have more capital than debt? Are they making money? Are they being innovative? Like all this stuff. That's when you go into the meat of the company. And then that's when you realize, okay, I should pour more of my money into this company, or I should just stay away. Or if you hear that a company is about to, quote unquote, fall, the news helps. And also researching a company and finding out their debt to capital ratio and all that stuff. Looking at all that, you then can make a sound judgment of whether to stay in that company, invest in a company, leave a company. So those are my initial advice or steps that you should take when you want to go into invest in. And once you get into it, I think once you're in the markets, you play around and you eventually learn. You learn through trial and error, but that's the initial steps to getting in. So I wanted to talk about what a stock market is, and all that goodness, right? So the stock market basically is an equity market, right? It's where people can go to buy and sell shares, but it's a place where you can go and trade and buy stocks, buy shares. I want to start this off by just, everybody should know the basic definition for investing. Investing is just taking initial capital and putting it into something else, such as like stock markets or real estate or gold or cryptocurrency. Just put it into something that would basically grow that initial capital. That's what investing is. So there are different types of investments. This type of investment I'm talking about are stock markets. Now, companies on the stock market are companies on stock markets are public traded companies, which means that they had to IPO for them to be actually in the stock market. So IPO meaning they had to fill out an initial public offering. Once they do that, they're in the stock market, and then they're considered a public traded company. And that way the public can actually buy shares, sell shares of that company. Private companies, not so much. They are not in the stock markets. They have to be public. So when you invest in a stock, what that means is that you're buying a percentage of that company. So it gives you the ability to have some kind of input into that company without actually owning that company, right? So with trading, investing, the stock market for the past 90 years has always given us an average return of 10%. So that means 10% return yearly. So that means that you put capital in, you put $1,000 into your account. Maybe say, let's just say you just put $1,000 and never put in any other amount in there, and you left it in that your investment account for a whole year. What that means is that from that $1,000 that you left there, you're earning $100. So it then brings your account to 1,100 without you even putting anything in. So stock investing is a quick way to, not a quick way, it's an easy way to grow your money. That's it. Until my next video. See you guys soon. Bye.